Three. Hello, people. What is going down? It's Friday. What's up, fellas?
What's going on?
What's up, guys?
So, today we're doing our live once again, folks, ladies and gentlemen. It's George Salas. I'll make a quick intro real quick. We've got this live. We're going live actually on YouTube, LinkedIn, Facebook, and Facebook groups.
Nice.
And we're going to talk about the short-term rental tax loophole today. My name is George Salas. I'm a short-term rental operator, real estate investor, fund manager, and we love creating lifestyle assets and cash flow for our partners, our investors, and ourselves. I want to introduce two of my boys right here. William Hollis, let's go, baby.
What's going on, guys? I'm Hollis from Hollis. My real name is William Hollis, but I'm from Hollis, Queens, so everyone calls me by my last name. I'm a real estate fund manager. We invest in short-term rentals. We do luxury fix and flip, multifamily to condo conversions, and I'm all about building out efficient real estate operations and bringing other people in to share the wealth.
Love it. And then we've also got my man, Brandon. What's up, brother?
Hey, guys. Yeah, so my name is Brandon. Instagram handle is Brandon Cashflow. That's what some people know me by, so I guess I'll use that name. Outside of the short-term rental space, I have invested and partnered on some multifamily in the Midwest, and super excited to see and really experience all that the short-term rental space has to offer.
Love it. Love it. Love it. Love it. So, very diverse group right here, right? So, folks, I want to talk today about the short term rental tax loophole. But before we get started, I just want to let everybody know that we are not accountants, we're not lawyers. So, this is not financial advice. And it is for informational purposes only. So, if you hear some cool stuff, you got to go check with your accountant or attorney. All right, so that's the first disclosure that I want to give to everybody. And then we're going to talk about 8 different points of the short-term rental loophole. We're going to give a little bit of feedback per each, right? So we all have our own opinions, right? And we're all invested in short-term vacation rentals. So we're going to start off with material participation. Really, for me, I think participation is just being active on the deal, but it doesn't, to me, it doesn't really just only mean that you're active on the grounds, moving around and doing all the chores. There are other aspects of the deal, right? To me, I mean, if you're running a short-term rental business, there's going to be bookkeeping, accounting, right? There's going to be assignment of cleaning to the teams. They're going to have a bunch of other things like managing reservations, other than managing the properties. You have managing the business, the marketing side on Airbnb, VRBO, your website. You have running the back end of the business, and then you have running the property. So, what do you guys think?
Yeah, when it comes to material participation, so I'm not a CPA, like George said, but my wife is a CPA.
Wow.
And she always talks about 2 words the IRS likes to use are, I believe it's ordinary and necessary. So when you materially participate in short-term rentals, it means doing anything that is ordinary and necessary to conduct the short-term rental business. So like George says, not necessarily swinging a hammer. You could be doing a lot of other things. They just have to materially contribute to the ordinary and necessary business of running a short-term rental.
Brandon.
Yeah, great question. So traditionally, if you're a real estate agent, if you're a real estate broker, you are considered to have active involvement in the real estate space, and there's many more tax benefits to those types of people. So if you own a property, typically you are considered to be passively invested. But if you have people who stay in your short-term rental who take less than 7 days, you by some definition of the IRS tax code, you are considered to have active involvement. So there's much greater tax benefits, which is pretty cool for the short-term rental space.
I love it. So again, going back to the 2 main ways to really get these benefits. One is material participation as an operator, right? And then one is real estate professional status, right? So right now we're talking about material participation. I know Brandon brought up, because he himself is a real estate agent. You do have a license, right, Brandon?
Used to, no
Used
longer. But at
Gotcha.
one point, I did.
Got it. So, now if you are not a licensed professional, you can still have real estate professional status. So you don't necessarily have to be a licensed professional. But on the material participation side, 100 hours. Well, let's talk about the real estate professional status. Are you guys familiar with that?
Oh yeah, spent many hours of my life diving into real estate professional status. It's the holy grail of real estate investing. Like, people devote a lot of time and energy to trying to achieve this because it's what gives you the greatest tax leverage in real estate investing. It basically means that it gives you a ton of deductions that you can take against your taxable income. But it is not something to mess around with. The IRS pays very close attention to people who try to qualify for real estate professional status. So I want to just put that out there. It's a great thing to have, but don't mess around.
You can't mess with it, right?
Yeah.
Yeah, you gotta be careful.
Brandon, what you got, brother?
Yeah, I don't know too much about it as Hollis does. I just know that there's greater tax benefits. You can take paper losses against your active income. So it just helps you keep more of what you make, basically.
Love it. Yeah. So let's move to topic number 3. We're like, what is this exception that we're really talking about? So I'm pretty versed on understanding what this means, right? So I'm gonna make it very visual for everybody listening out there. So there are 2 types of income when you rent a property, right? So one type is passive income, and one type is active income. So all of your rental real estate, right? All of your rental real estate is considered passive income if you are not materially participating, you're not a real estate professional, you're maybe an investor, so like a passive investor, an LP, limited partner, right? And then a syndication or fund. But then you have this exception, right, where because short-term rentals are active income and not passive, what happens is when people think of rental real estate and the deductions and losses you can take, you think, okay, I'm going to take the losses against passive income. So because real estate is passive when it comes to income, right, for most, then it actually becomes active, right? So the income, it becomes active, so the losses become active. And in a sense, it moves in this half. Think of it as half. Passive income, passive losses, active income, active losses. Now you've got short-term rentals that most people think there's the passive side. It gets moved over to the active side. That's the exception, the loophole everybody talks about. Right? So you guys want to go at it real quick?
Yeah, I think you nailed it. The exemption we're talking about is the exemption to what's required for real estate professional status, right? Because people who have real estate professional status can claim real estate losses, which would normally be passive, against their other active income, because basically the IRS is saying, hey, all of your business is in real estate, so all of your income is active, right? We'll just consider all your income active for the most part. The short-term rental exemption, but the requirements are very strict to become a real estate professional. I'll go back to that. The short-term rental exemption essentially lowers the barrier a little bit for achieving that same or similar status to real estate professional status. So you're exempt from achieving some of the things like, to be a real estate professional, for example, you have to spend 750 hours or more in real estate activities. Really, it needs to be your full-time job, essentially. With the short-term rental exemption, or the exception rather, the hour requirement is much lower, and there's a few other things that allow you to take advantage of some of those reps or real estate professional status benefits.
So the loophole right there is the 100 hours versus 750. Right?
Big difference.
We're going to get deeper into like how do you split that, what those 100 hours are, but hey, you just got to be involved in your business. For 100 hours a year, you divide that, that's about 8 hours a month.
Mm.
So that defines, and then you have to ask your CPA to make sure that you're complying. You get everything.
Definitely.
Brandon, any
Yeah,
thoughts
I just I think it could be a lot more beneficial for certain people, or it might be more appealing to have a short-term rental versus trying to get their real estate license because it's not like it's a super hard test, but it still requires a lot of studying, and you might not pass it the first time. So just having the ability to buy a short-term rental and get treated the same way from a tax perspective, I think could be helpful for a lot of people.
I love it. I love it. And then topic number 4 here, fellas, is the 100-hour rule.
Mm.
So, what is that? 100 hours. What is 100 hours? So,
That goes back to material participation, right? You have to actually do something. You can't just say, buy it and pay somebody else to do every single thing and you never pay any attention to it. You still have to materially participate in your short-term rental activity. So get involved in the business. Again, not necessarily swinging hammers, but you need to do something that's ordinary and necessary for the operations of your short-term rental for at least 100 hours. So that can be, you can be on the cleaning staff, you can be the person taking some of the guest messages or sharing in some of those interactions. You can do some bookkeeping, whatever it is. You just need to do ordinary and necessary things for 100 hours. That's part of how you can qualify for that exemption or loophole.
Yeah, Brandon, you want to talk about that?
Yeah, sure, absolutely. I think it's a great rule because it doesn't specify what you have to specifically be involved with. It just says that you have to be involved. So if you're good with your hands, if you're a handyman, maybe you lean more so into the repairs of the property. If you're great at marketing, you could, list your property on Facebook and on Instagram, the Airbnb and VRBO. So it just lets you lean into what your strengths are because it's not really specified, which is pretty cool.
So that's another loophole right there, right? So their IRS sometimes doesn't specify. When I have meetings with my accountant, she's like, well, they don't specify. I'm like, okay, so what's the loophole? How can we go around? I love loopholes, ladies and gentlemen. I love them, right? So as long as you're not breaking the law,
Yeah.
you have a loophole.
Legal.
100 hours of whatever work you do. Now, big difference here, fellas. For us, right here in the group, and someone that's getting their first short-term rental, right, they're going to be doing maybe the cleaning themselves, maybe the front desk and all that stuff. I don't do that anymore. How do I get that, right? So here's a quick example. As an operator, right, I still lead a team. As an operator, I still sometimes need to oversee the pricing strategy for our portfolio. I'm very good at the pricing strategy. So I still run the pricing strategy for my own portfolio. Cool, right? So that counts for that time. I have meetings with my team every Monday, and this is all towards our short-term rentals. So it doesn't necessarily have to be you being that boots on the ground or you being that hands-on front desk person. It could be leading a team, overseeing part of the asset financials at the end of the month, spending some time doing that. 8 hours a month is equivalent to about 2 hours a week. The question that you should ask yourself is, if you're managing one, is completely different material participation. If you're managing 5, it's different. If you're managing 20, 30 properties, right, like we are, that is a completely different type of material participation to get those losses. So that is a big one that I want everybody to understand that. So we're not talking about, hey, you got to get the boots on the ground, because I know most of the people out there that are not just getting started, or they're not active, or they're maybe wanting to passively invest. They're not gonna want to be doing the cleaning, the maintenance, and guest interaction, right? That's for the most part. If you have a property management company, and you're running 3, 4, 5 properties, you can still take advantage of those loopholes, those deductions, right? So now let's get into what is depreciation really? Like, what kind of depreciation deductions we're talking about, right? So what is that, Hollis? What is that about, bro?
And that's really the crux of it, right? Is what we're talking about is being able to take these losses, because You say you made $100,000 a year and in your business, and you have some expenses, so you can deduct those expenses, right? And then you're taxed on the remainder. I think everybody's pretty familiar with that. Well, cool thing in real estate is it has this thing called depreciation, which means it's basically a free tax deduction because your building is getting older every day. And so the government says you can have this percentage of the building's value. That's obviously paraphrasing, but you get this percentage of the building's value as a deduction. Now, normally that deduction is stuck. Remember what George said about the passive side and active side. Normally that deduction is stuck on the passive side, meaning if I'm a doctor and I have a rental property, I cannot use that depreciation deduction against my doctor income because my doctor is my active and the depreciation is on the passive side, right? Well, when you apply these short-term rental loopholes and real estate professional status that we're talking about, that depreciation deduction now moves over to the active side. And we'll get into in a little bit why that's so powerful. But the depreciation is just a deduction that you get for owning properties and tools and goods that slowly deteriorate over time.
Yeah, and a quick loophole in there is that there's a 27 for residential real estate and a 39. So your CPA can determine what short-term rentals are. Typically, we file our short-term rentals in their 39-year deduction. And there's another cool topic that we're going to talk next, right? But Brandon, what do you think about that, brother?
Yeah, I think it's cool because there's certain parts of your property that wear down over time, and some are quicker. And actually for residential, it's 27 and a half years, but not that makes a big difference.
27 and a half. Yeah.
Yeah, I did a lot of research on it, but appliances in your kitchen might wear down over the course of 5 years. Your floor might wear down over 10 years. Your roof might take 15 years to wear down. So it's cool to be able to take depreciation in a shorter time period for certain parts of your property.
Absolutely. Next topic, cost segregation. We're going through several of these right now. I love cost segregation studies. I did one for 125 from one of my properties. I did this movement, refinanced it. It went under my personal name for a little while. Then I refinanced it back to our trust. So I'm getting just in one deal, $125K deduction.
Wow.
A study called cost segregation. A bunch of companies doing it out there. And I don't even have to break that down. You hire someone that specifically focuses on short-term rental cost segregation. And for $2,000, $2,500, some companies charge more, but our deal is about $1,800 to $2,000. You are able to literally, you make $100K in 2024. You buy one house, you deduct, you do this cost segregation study. Next year, when you're filing your taxes, you're going to take $125. So now you have a negative $25,000 loss. You don't pay any taxes on the $100K. Boom. How's that?
Yeah, that's the sweet stuff, right? Because what we just mentioned before about depreciation, it's great, right? It's like, yeah, you can take this deduction every year for the next 20, what is it? What do you say, Brandon? 27 and a half, 29 and a half?
Yep, 27 and a half. 27
and a half years. This little kind of small coins, right? Which is fine. Great. Have your small coins. But cost segregation study basically analyzes the property on a closer level to allow you to pull more depreciation. So you can essentially use a cost segregation to accelerate your depreciation. So instead of it taking all these, 27 plus years, you can condense it down and take a lot more of it up front, because especially if you're an investor, you may not even hold your property for 27 years, right? So why leave all that money on the table when you can do the cost segregation, condense that depreciation into the front load it, so to speak, and take all that. So that really cranks up the tax benefits. And when you really understand it, that's why people get excited about short-term rental loopholes and real estate professional status, because think about what George just said, a $125,000 deduction.
One property.
From one property. Let's say he's a $200K a year earner. That's minus $125,000 tax deduction, right? So now his taxable income,
$75K.
That's a big difference.
So then you go from a, like higher tax bracket to a lower tax bracket, right? So that also helps. So that knocks you down a tier. You can't beat it, right? So now Brandon, go. I wanted to throw a little trick here. Like what happens if you buy one property every year? But let's hear what you got, brother.
I'll keep it brief because you guys did an awesome job of really going very high level with it. But the only thing with cost segregation, you just can't take depreciation on the land. But I think a lot of people know that. But it's still pretty meaningful for the tax benefits. And then what Hollis talked about, typically, you could take that depreciation from a 27-year sort of schedule down to 5 years or even 7 years. So it's just very powerful once you're able to take advantage of it.
Love it. Thank you, brother. You brought a good point there. Yeah. So, man, what happens if you do this every year and you buy one property per year? You are never going to pay taxes unless you're making like $400,000 or $500,000, and then you have to buy 4 or 5 properties, right, in net. So most people, they make $80,000 to $150,000 a year, which they could live comfortably with $100,000 to $150,000, right? Most states now. I mean, California, Colorado, you can't do that anymore, right? So what happens then? That's the strategy. If you get anything else out of today's 25-minute call, one property per year gets you no taxes ever. Boom.
But wait, how do you buy one property a year, George?
Well, you do step 2 is one of our best strategies. That shouldn't be that hard, right? That's another topic. How about this? How do we take and we strategize never paying taxes by buying sub 2s? Maybe that's the topic for next week.
We could talk about it. There's other ways too to take some of these tax benefits from cost segregations and things like that. So, but like George said, it's a cycle that you want to be able to continue, right? Take the money that you saved from not paying taxes and use it again towards another investment. And that's how you create a snowballing effect.
Love it. Folks, if you're liking this, leave us a comment. Say, hey, great stuff. Any of our profiles or any of the videos, we're actually live in like 12 to 13, maybe.
We're all over the place right now.
So we love comments because it makes the algorithm kick us up a little bit. So more people see the value that we're bringing here.
Definitely.
So what else, folks? I think we've got 2 more, but these are more a little bit more
nuance.
So we've got a section 179 deduction in state and local regulations. Basically, the section 179 deduction is a provision that allows owners, here are my notes here, to deduct the cost of certain property improvements immediately rather than depreciate them over time, further reducing taxable income in the year the expenses occurred. This deduction is maximized through a company which hires you, and then the vehicle for that is the cost segregation study. Okay, so that's a deduction that people take advantage of. And I don't know why we're really, this is too technical for everybody out there, right? And the last one is the state and local regulations. They change for everybody. So just be careful to talk to somebody in your state. Laws are different, right? So other than that, what we got coming up, fellas?
Oh man, we got some goodies in the hopper. Talking about how to buy one property every year. How about how to buy 18 properties in 1 year?
How to buy 18 properties in 1 year, like it's buying one.
Like it's buying one.
Less headaches, less work. So
I don't know if we could even go into that on this call, though. We might need to do a follow up for that. What do you think?
Hey, next Friday, join us, okay? So now we've got things worked out so that we can all meet in the morning, right? So we've got a 10:30 Friday. So schedules have been a little off, so we decided to do a live at 2 today. So drop. We're going weekly now, right, fellas? Weekly.
That's it.
So real estate, commercial, residential, right? Short-term vacation rental, oriented live stream every single Friday. We should throw a name for it. Short-term rental for cash flow. We'll come
Cash
up
flow
with
never low. That's Brandon's tagline right there.
cash flow never low. Yes.
We could use it. We could definitely use it.
Love it. All right, folks. Thank you for joining us today. Share, comment, like this post in everybody's social media or the one that you're watching on right now. So thank you.
Yes, sir. Let's do it.
Have a great weekend, guys.
Take care.